Today, I'm going to break down the key signals that point toward the next financial crisis, how they're forming right now, and most importantly, what you can do to protect yourself before panic sets in. This isn't fear. This is preparation. What if the next financial crisis doesn't look like 2008, doesn't start on Wall Street, and doesn't even feel like a crisis until it's too late in 2007? Housing prices were guaranteed to rise. In 1999, tech stocks were the future. In 2020, markets were strong. Right before they shut down, we're seeing warning signs again, but they look different. They're quieter, more digital, more complex. When we look deeper into how financial stress actually spreads through the economy, it's important to understand that crises rarely arrive as a single dramatic event. Instead, they unfold in layers, often starting with small cracks that most people ignore. For example, a rise in late payments on credit cards might seem insignificant at first, but that signals households are stretching their budgets just to maintain the same standard of living. When millions of households do this simultaneously, consumer spending, the engine of the U.S. economy, starts to slow. Businesses notice the slowdown quietly, often through weaker sales growth or shrinking margins, and their first response is not panic but caution. They freeze hiring, delay expansion, and cut back on investment. This cautious behavior then feeds back into the job market, making employment less stable, which further pressures consumers, creating a cycle that accelerates without making front-page news. At the same time, financial markets may continue rising because liquidity is still present and optimism hasn't fully faded, creating a dangerous illusion that everything is fine. This disconnect between market performance and underlying economic health is one of the most misleading signals for everyday investors, because it encourages them to take on more risk at exactly the wrong time. Another layer that deserves attention is how modern financial systems are deeply interconnected through technology and leverage. Automated trading systems, exchange-traded funds, and derivatives are designed for efficiency in calm markets, but during periods of stress they can amplify volatility. When prices start moving quickly, algorithms respond instantly, often selling into weakness, which can turn a manageable correction into a rapid sell-off before human decision makers even have time to react. This is why recent market drops tend to feel faster and more aggressive than those of previous decades. In parallel, the role of confidence cannot be overstated, because money itself is ultimately a system built on trust. Trust that banks will remain solvent, that currencies will hold value, and that institutions can manage crises effectively. When that trust erodes, even slightly, people change behavior in subtle ways, such as holding more cash, reducing spending, or moving assets into perceived safe havens. These individual choices may seem rational on their own, but collectively they can drain liquidity from the system, making downturns sharper and recoveries slower. It's also worth noting that policy responses, while often well-intentioned, can introduce new risks. Aggressive stimulus can inflate asset prices, while rapid tightening can expose vulnerabilities that were hidden during periods of easy money. This creates a narrow path for policymakers, where any misstep can accelerate instability. For individuals, the challenge is navigating this environment without becoming paralyzed by fear or overconfident in optimism. Preparation does not mean predicting collapse or exiting markets entirely. It means understanding where you are exposed, recognizing that cycles are inevitable, and positioning yourself to withstand volatility rather than be forced to react to it. Income stability, manageable expenses, and flexibility become more valuable than chasing maximum returns. History shows that those who maintain liquidity and patience during uncertain periods often gain access to opportunities that are unavailable during boom times, whether through discounted assets, new business ventures, or career advancement when competition thins. At the same time, it's important to remember that financial systems are resilient, and while crises can be painful, they also lead to restructuring, innovation, and long-term growth. The danger lies not in the existence of cycles, but in ignoring them or assuming they no longer apply. Each generation tends to believe it has outgrown the mistakes of the past, yet human behavior remains remarkably consistent, driven by fear, greed, and the desire for security. By paying attention to early signals, maintaining discipline, and focusing on fundamentals rather than noise, individuals can move from being passive participants in the financial system to informed decision makers who respond thoughtfully rather than emotionally. This mindset shift is perhaps the most powerful tool available, because while markets, policies, and technologies will continue to change, the ability to adapt calmly and strategically is what ultimately determines who struggles during periods of crisis and who emerges stronger on the other side. As this environment evolves, another critical factor to understand is how narratives shape financial behavior far more than facts do in the short term, because markets move not only on data but on interpretation, expectations, and emotion. When people repeatedly hear that the economy is resilient, that consumers are strong, and that innovation will solve structural problems, they tend to discount warning signs, even when those signs are measurable and persistent. This doesn't mean optimism is wrong, but excessive optimism can delay necessary adjustments, allowing imbalances to grow larger and more dangerous. One clear example is how inflationary pressure reshapes decision-making across all income levels. When prices rise faster than wages, people compensate by borrowing more, working longer hours, or dipping into savings, which temporarily masks stress but weakens long-term stability. Over time, this erodes the financial buffer that households rely on during downturns, making even a modest shock feel severe. Businesses experience a similar dynamic. facing higher input costs, wage pressures, and financing expenses simultaneously, forcing them to choose between raising prices, which reduces demand, or absorbing losses, which reduces profitability. Neither option is sustainable indefinitely, and the longer these pressures persist, the more fragile balance sheets become. Another overlooked element is demographic pressure, particularly how aging populations and shifting workforce participation affect growth, productivity, and government finances. As more people exit the workforce and fewer replace them, economic expansion becomes harder to sustain without increasing debt or financial engineering, both of which introduce additional risk. At the same time, technological advancement, while immensely powerful, can act as a double-edged sword by increasing efficiency but also concentrating risk. When systems become highly optimized, they often lose redundancy, meaning they perform exceptionally well under normal conditions but fail abruptly under stress. This is evident in supply chains, financial markets, and even employment structures, where gig work and contract-based income offer flexibility but less security during downturns. These structural shifts mean that the next financial crisis may feel less like a sudden collapse and more like a prolonged period of instability, where growth is uneven, volatility is persistent, and recoveries are slower and more selective. For investors and households, this changes how risk should be evaluated, because traditional assumptions about diversification and safety may not hold in the same way they did in previous decades. Correlations between assets tend to rise during stress, meaning that things assumed to be independent can fall together, catching unprepared participants off guard. This is why understanding liquidity is just as important as understanding returns. Assets that appear valuable on paper may be difficult to sell quickly without taking losses when everyone else is trying to exit at the same time. Psychological resilience also becomes a defining factor, because prolonged uncertainty can lead to decision fatigue, causing people to abandon well-thought-out plans in favor of reactive choices driven by headlines or social pressure. Financial media, designed to capture attention, often amplifies extremes, swinging between optimism and alarm in ways that can distort perception rather than clarify reality. Learning to step back from this noise and focus on long-term objectives is not easy, but it is essential, especially in an environment where rapid information flow can create a sense of urgency that isn't always justified by fundamentals. Another dimension worth considering is how policy responses themselves can change behavior in unintended ways. When people believe that markets will always be supported, they may take greater risks, increasing leverage and speculation, which ultimately makes the system more vulnerable rather than more stable. This dynamic has been observed repeatedly, where measures designed to prevent short-term pain contribute to larger problems down the road by delaying necessary corrections. On an individual level, adaptability becomes more valuable than prediction, because no model or expert can accurately forecast the timing or trigger of the next crisis. What can be controlled, however, is personal exposure to uncertainty through diversified income streams, continuous skill development, and financial flexibility that allows for adjustment rather than desperation. Careers like investments are subject to cycles, and those who invest in learning, adaptability, and network resilience tend to recover faster from disruptions than those who rely on static roles or single sources of income. This broader view of financial health extends beyond numbers on a balance sheet and includes mindset, behavior, and preparedness for change. Ultimately, financial systems reflect human behavior at scale, and while technology and policy can influence outcomes, they cannot eliminate cycles rooted in psychology and incentives. Recognizing this reality does not require pessimism, but it does require humility, an acknowledgement that stability is temporary and must be actively maintained rather than assumed. By internalizing this perspective, individuals move away from chasing certainty and toward building resilience, understanding that the goal is not to avoid all risk, which is impossible, but to manage it intelligently in a world where change is constant and shocks are inevitable. One of the most important realizations people come to during periods of economic stress is that financial systems are not just mechanical structures driven by numbers, but living ecosystems shaped by incentives, behavior, and confidence, and when those elements fall out of alignment, instability becomes unavoidable. As conditions tighten, you often see a subtle shift in priorities, where survival replaces growth as the dominant objective for both individuals and institutions. Companies that once focused on expansion begin emphasizing cost control, automation, and efficiency, which can be positive in the long run but painful in the short term as jobs are reduced and wages stagnate. This transition phase is particularly difficult because it doesn't feel like a crisis in the traditional sense. Instead, it feels like persistent pressure where progress slows, optimism fades, and uncertainty becomes the default state. Consumers adapt by becoming more selective, prioritizing necessities over discretionary spending, which disproportionately impacts sectors like retail, travel, entertainment, and luxury goods. These industries are often early indicators of broader economic stress, as declining demand forces businesses to restructure or exit the market entirely. At the same time, regional disparities become more pronounced, with certain areas experiencing sharper slowdowns due to reliance on specific industries or higher costs of living, while others appear relatively stable, reinforcing the illusion that problems are isolated rather than systemic. Another layer to consider is how currency dynamics and global capital flows influence domestic conditions. When investors perceive rising risk, capital tends to move toward perceived safety, strengthening some currencies while weakening others, which can increase import costs, pressure exporters, and complicate monetary policy decisions. These shifts can happen quickly, driven by sentiment rather than fundamentals, making them difficult to anticipate and even harder to manage once they begin. In this environment, financial institutions must balance profitability with prudence, often reducing exposure to riskier assets and tightening standards, which further constrains economic activity. This cautious stance may protect individual institutions, but can collectively slow the system, illustrating how rational decisions at the micro level can create unintended consequences at the macro level. Individuals navigating this landscape face similar trade-offs, weighing the desire for opportunity against the need for security, and this tension often reveals gaps in financial literacy that were less apparent during periods of easy growth. Many people discover that their understanding of risk was based on assumptions formed during unusually favorable conditions, leading to a reassessment of strategies that once seemed sound. This reevaluation process can be uncomfortable but ultimately constructive as it encourages more realistic expectations and disciplined planning. It also highlights the importance of aligning financial decisions with personal circumstances rather than external trends, because strategies that work for one individual or household may be inappropriate for another depending on income stability, obligations, and time horizon. As volatility becomes more common, patience emerges as a competitive advantage, allowing those who can avoid forced decisions to observe, learn, and act selectively rather than react impulsively. Over time, this patience can translate into tangible benefits, such as acquiring assets at more reasonable valuations or repositioning careers toward areas of growing demand. It's also during these periods that innovation often accelerates, not in speculative excess, but in practical solutions aimed at efficiency, resilience, and cost reduction. Companies and individuals who focus on solving real problems rather than chasing trends tend to build durable value that persists beyond the cycle. Meanwhile, social attitudes toward money and risk evolve, with greater emphasis on sustainability, stability, and long-term planning, reflecting lessons learned from recent disruptions. This cultural shift, while gradual, influences policy, corporate behavior, and consumer preferences in ways that reshape the economic landscape over time. Education and transparency become increasingly important as people seek clarity in an environment filled with conflicting information and rapidly changing conditions. Those who invest in understanding how systems work, rather than relying solely on predictions or opinions, are better equipped to navigate uncertainty with confidence. It's also worth noting that resilience is not purely financial. Emotional and psychological preparedness play a significant role in decision-making during stressful periods, affecting everything from spending habits to career choices. Stress can narrow perspective, making short-term relief seem more attractive than long-term stability, which is why having predefined plans and principles can be so valuable when conditions deteriorate. By anchoring decisions to well-considered frameworks rather than momentary emotions, individuals reduce the likelihood of costly mistakes that are difficult to reverse. Over extended periods of adjustment, these small, disciplined choices accumulate, shaping outcomes in ways that may not be immediately visible but become clear in hindsight. The broader lesson is that financial cycles are not anomalies, but recurring features of complex systems. And while each cycle has unique characteristics, the underlying dynamics of leverage, confidence, and adaptation remain remarkably consistent. Recognizing this continuity allows individuals to contextualize current challenges not as unprecedented disasters, but as phases within a larger pattern, encouraging a balanced response that neither dismisses risk nor exaggerates it. In doing so, people shift from viewing financial stability as a static achievement to understanding it as an ongoing process that requires attention, flexibility, and thoughtful engagement with an ever-changing environment. As we bring all of this together, the most powerful truth to remember is that financial crises are not sudden accidents that come out of nowhere. They are the result of pressures that build quietly over time, visible to those who are willing to look beyond headlines and short-term optimism. The signals we've discussed, rising debt, tightening credit, asset bubbles, systemic fragility, and widespread complacency are not meant to create fear, but awareness, because awareness is what turns uncertainty into preparation. You don't need to predict the exact moment the next crisis begins to protect yourself from it. You need discipline, flexibility, and a clear understanding of your own financial position. History consistently shows that those who remain calm, reduce unnecessary risk, maintain liquidity, and focus on long-term fundamentals are not only able to survive periods of instability, but often emerge stronger on the other side. The future will reward those who think independently, who resist emotional decision-making, and who prepare during times of calm rather than panic during times of stress. Economic cycles will continue, markets will rise and fall, and uncertainty will always exist, but your response to these realities is what ultimately determines your outcome. If this message challenged the way you think about money, risk, and the future, take a moment to subscribe to the channel so you don't miss insights that help you stay ahead of the curve, and share your perspective in the comments below, because the smartest financial decisions are made by those who learn early, stay prepared, and act before the rest of the world is forced to react.